If you rent an apartment, you have likely endured some version of this conversation. You mention to a coworker or a family member that you just renewed your lease, and they give you a look of mild pity before delivering the classic line. You know, renting is just throwing money away. You really need to buy a house. You smile and nod, but underneath you feel a quiet anxiety. The cultural pressure makes you feel like you are failing at money, missing out on the single most critical milestone of adulthood. Let's check the receipts on the housing market right now. The median existing home in America currently sits at an imposing $418,800, and the 30-year fixed mortgage rate is hovering around 6.3%. This chart tracks the crucial metric of housing affordability, the U.S. home price-to-income ratio. Historically, from 1975 through the late 1990s, that line rested comfortably around a 3.0. Today, you can see it spiking right up to a 5.0, blowing past even the 2006 peak. To translate that abstract 5.0 ratio into real human labor, it means buying the median house now requires 5 full years of a median worker's entire pre-tax salary. Every penny you earn for 60 straight months, poured into a single purchase. At this ratio, the traditional milestone of home ownership serves as a beautifully decorated financial trap. Take a look at Lucas and Michelle. They have $80,000 saved up and decide to buy a $400,000 house, leaving them with a $320,000 mortgage. This $1,980 monthly payment splits in month 1. $299 goes toward the principal, while $1,680 evaporates into interest. Over a 30-year timeline, the red interest curve doesn't drop below the green principal until year 19. Lucas will be 51 before the math flips. The mortgage itself is just the cover charge. Homeowners face what I call the hidden subtractions. Since 2021, homeowners' insurance has risen by 46%, and the cost of basic annual maintenance, like fixing a leaking roof or replacing a dead HVAC system, has jumped 42% in just 5 years. Add in the rising homeowner association fees and property tax ambushes, where the county immediately reassesses the property at its new, higher market value the minute you close on the house. When you tally the interest, taxes, insurance, and maintenance, Lucas and Michelle face $34,000 a year in completely unrecoverable sunk costs. None of that builds equity. Look at this direct side-by-side comparison. Renting a comparable home for $2,000 a month puts the renter at $24,000 a year. The sunk costs of owning that identical property tower over it at $34,000. If spending $24,000 on rent is throwing money away, handing a bank and the local county $34,000 in pure unrecoverable expenses is objectively worse. There is an alternative wealth-building engine. I call it the do-nothing portfolio. The strategy works like this. You take that initial $80,000 down payment, plus the monthly cash you save by renting instead of paying for taxes and maintenance, and you automate it into a broad S&P 500 index fund. This is simply a low-cost tool that buys you a tiny fraction of every major successful corporation in America. Look at this compound interest curve. At a conservative 7% return, the renting strategy reaches $1.22 million over 30 years. Now add the homeowner's trajectory. After 3 decades of taxes, repairs, and selling fees, their net worth caps out around $885,000. This aligns precisely with historical records. Nobel laureate Robert Shiller studied 130 years of data and found that real U.S. home prices, adjusted for inflation, stayed essentially flat from 1890 to 1997. Over that exact same century, stocks consistently delivered real returns of 6.5 to 7%. Consider Ronald Reed, a Vermont gas station attendant and janitor. He didn't flip real estate or borrow $500,000 from a bank. He just bought reliable blue-chip stocks and did absolutely nothing for decades. He passed away in 2014 with an estate worth roughly $8 million. The lazy method of consistently buying index funds mathematically and historically crushes the high-stress, high-fee reality of managing a physical property. If the math so heavily favors renting and investing the difference, why is there such intense societal pressure to buy? This pressure is a byproduct of the National Association of Realtors, which spent $86 million on lobbying, more than any other organization in America. They spend another $66 million a year on marketing to protect a brand synonymous with success. This massive corporate investment creates the cultural script your friends and family read from when they tell you renting is a failure. You are up against an enormous ecosystem of banks, title companies, and mortgage brokers, whose financial survival depends entirely on making you feel inadequate, so you will sign a 30-year debt instrument. That system creates a suburban illusion. The people judging you often have massive finance trucks in their driveways and empty rooms in their McMansions, secretly drowning in credit card debt and tapping into home equity lines of credit just to stay afloat. Actual wealth is what you don't see. It is the quiet liquidity of an index fund. It is a 10-year-old paid-off sedan. It is the absolute absence of panic when the dishwasher breaks, because you just tap an app and let your landlord fix it. Being priced out of the 2026 market is a stroke of financial luck. It keeps you from tying your entire net worth to an illiquid, heavily taxed structure that costs 3 times what it should. You have permission to change your default settings. Rent aggressively, automate your investments, and walk away.